Hello there, YouTube. So if you're watching this video, you've probably seen the headline there on the top and wondering, can I use an LLC to protect my personal assets? Right? So in this example, we're going to look at John's a small business owner. He's accumulated a bunch of cash. He's got stocks, bonds, investments across the board, bought a vacation house. But John is worried, well, everything is being held in my name personally. Is there anything I can do to provide me some additional layer of protection if I get sued by a customer? Or let's say I'm just driving down the road and I hit somebody with my vehicle, right? So it's got nothing to do with my business, but I did hit somebody and now I'm being sued by them, my insurance is involved. I've got all these assets in my name. Can I protect myself and my nest egg from these types of contingencies? Is an LLC a good option? Well, it might be, but it's not exactly that easy, right? So what are the rules and what are the issues here? An LLC at its core is still a business entity, right? So LLCs can only provide you that asset protection if you drop everything to an LLC and it's still being conducted kind of like a business, right? It's got to look like a legitimate business entity, or else any kind of court or creditor can easily basically just dismantle the structure and say, this is just an alter ego of you personally, right? So you don't get the benefits of having that limited liability protection to safeguard those assets. And it's broadly referred to as this piercing the corporate veil type of issue. Now, so it says piercing the corporate veil. This concept started when we just had corporate entities in the United States. The LLC is relatively new. Almost every state has some sort of LLC legislation now. But what's important is this concept of piercing the corporate veil, that applies to LLCs too. And so some of the highlights that a creditor would be looking for are, if there's no separation between the business and your personal kind of lifestyle or assets, or that of the owners rather, it is just an alter ego of you personally, and so that's an easy way to, just torpedo the whole structure to begin with. One of the other ways a creditor could, quote, pierce the corporate veil is if the company commits some type of fraud. And when I say piercing the corporate veil, what I'm talking about is the whole structure coming undone. So the liability can flow up and down, both ways, right? So let's say John is sued personally and the creditors are trying to come after some of his assets to satisfy a judgment, and he says, oh, well, look, I've got this LLC interest and there's a bunch of stuff in there, but because it's an LLC, you can't go in and take my assets. They could, right? They could if the LLC fails to follow all these formalities and maintain this legitimate business entity type. And then the piercing the corporate veil comes down the other way too, right? If the LLC itself has a customer that sues or there's some other type of judgment, piercing the corporate veil would allow the creditor to come after John personally for his other stuff, right? So you're worried about both streams of liability here, both up and down through the entity. Okay, so additional elements for piercing the corporate veil. If you fail to follow all the formalities under the operating agreement. So the nice thing about LLCs, which differs from corporate entities, is corporations have pretty rigid formalities under state law. You've got to have corporate bylaws. You've got to have shareholder meetings where you keep minutes. You've got to have board of director meetings where you also keep minutes. You've got to have proper stockholder ledgers in place that shows who owns what class of stock and how much. All of these things you have to document in the event that you are sued, or else the creditor can argue corporate formalities weren't followed, and so the entity's basically almost as if it doesn't exist. LLCs are a little better in that they don't have to do all of that extra kind of admin, and most states don't even require an operating agreement under state law, but we highly recommend you have one in place. So the LLC operating agreement can be drafted in such a way that it'll give legitimacy to the business. And there's certain provisions that you can include in it that provide more asset protection that otherwise wouldn't be available under state statute. So very, very important to have a good LLC operating agreement in place. And again, that will help legitimize the entity and prevent this piercing the corporate veil issue. Another way that creditors can dismantle an entity is if you just don't maintain proper accounting records and do all your tax filings. And that's kind of obvious, right? I mean, every business entity, in order to maintain any kind of legitimacy, has got to have good accounting records, right? They've got to have good accounting records for book and tax purposes, and you got to file tax returns, not just the business itself. In most contexts, we're talking about an LLC that's a partnership tax structure. And so the LLC might need to file a return, and the owners have got to do a return as well. And the last thing we've got on the list here is just flat out commingling business assets and personal assets, right? Or you're just using business assets for personal use. So in a lot of family type of partnership structures, which we'll talk about later here, the entities might own vacation properties, or they'll own vehicles or other pieces of assets. And those are supposed to be just for the business, right? You can't just go in and start using, let's say, a piece of real estate for personal use if it's part of the entity and it needs to be rented out to third-party tenants and actually run like a business entity. So if John wants to go down the route of setting up an entity and perhaps putting all these assets in there, one thing he can consider is a family partnership type structure. So these have been around for a long time. They do work a lot for tax and estate planning purposes. So let's look at some of the highlights here. Using a family limited partnership or family limited LLC type structure. Very popular structure for credit protection, and it's also a really good way to kind of transfer assets out of your estate to your kids, your grandkids, perhaps charitable beneficiaries. A lot of flexibility there, right? So in principle, what it is just a holding company. It's a holding company that operates as a business that holds title to all those assets that you otherwise held in your name personally. So John had a brokerage account in his name and he had, let's say, $300,000 in stock. Under the FLP structure, you would set up the LLC. The LLC would open its own brokerage account and you would transfer title to those stocks, that cash, into that account. And so now it's held in the business rather than you personally. That's effectively what's happening here, is you're taking all your personally held assets, the ones that you're okay with contributing to the business, and you're moving them into the business entity. And it runs, the best way I can describe it to people is, you want to think of it being run like a private equity fund or a hedge fund, but the membership interests are exclusively to you and your family, right? So hedge funds, they set up LLCs, they set up limited partnerships that have a general partner, and they issue LP units to just various individuals. That's basically what's happening here, but it's just being done within your close-knit family group. Okay, so ownership is separated into two categories. We have general partners that control the operations of the entity. In an LLC context, this is often referred to as member manager, but it's normally ideal, or it's better to have a manager manage LLC for additional asset protection purposes. But you have those GPs that run everything, and then you have other individuals or investors that are purely limited partners, right? So they put capital in, they have a beneficial interest in the assets and the income streams, but they don't actually, they're not involved in any kind of day-to-day decision making. They don't pick, investment objectives or targets or goals or anything like that. All of that is left up to the general partners and the managers of the entity, right? And so again, just to reiterate here, the partnership has got to be kind of operated like a regular business, or think about a regular private equity fund or a hedge fund that has these various investors, which will be your family. If it's not operated in such a fashion, then if a creditor or somebody else does sue and try to seize those assets, they can always argue that, well, the formalities weren't followed, and so for that reason, we're just going to go ahead and take the assets. Certainly not what you want to have happen, right? And so the Llc Operating Agreement, again, very important. And you want the terms to look like something you would see in a third-party arrangement, right? That, again, adds credibility to it. If you draft an agreement that is so, let's say, one-sided, where it basically flat out says, oh, well, John can put money in, but he can take money in and out however he pleases. He could do this, he could do that. If you're giving the individual that's funding the entity or even the other limited partners a lot of control and flexibility over what's happening without kind of following some sort of rigid formula, then again, it looks like an alter ego issue, right? I mean, what's the point of dumping all these assets into the entity if you can just continue to use them, take money in and out as you please, just as if it was held by you in your personal name? That would be the issue. Maintaining accurate records and tax filings, again, a big one, big point there to make sure that's done. And then the personal use of assets. So as an estate planning attorney and a tax attorney that deals in this space heavily, I am on the fence about persons using business property for personal use. So the vacation one, for example, if you put a vacation property into the LLC, you got to actually treat it like it's a third-party property. So you got to pay for it, right? So if you want to rent the property for, let's say 10 months out of the year, you're going to Airbnb it to just random people that approach you online to be able to rent the property. That's fine, that's great, because now it looks like kind of a pseudo vacation rental versus a pure rental type of asset. But then if you want to use it for personal reasons, you have to continue to treat it as if you're just a regular Airbnb user. So you would rent it for, let's say, 2 weeks, you would pay whatever the fair market rent value is, and you would actually pay it, right? You can't just, book some sort of accounting entry where you're recording the rental income and not actually paying it. That's not going to work. So you do have to pay for use of the asset. And I think most of the time it's okay, but you don't want to abuse it. So yeah, it depends on how aggressive you want to get with these kind of mixed personal use versus business use assets. If you're super conservative, you don't want to do anything like that. So no business or personal use commingling whatsoever. If you want to go down the path where you're going to have personal use assets and or business assets, sorry, and you might want to personally use them at some point throughout the year, you can do it, but you have to tread very carefully. Make sure it's a third-party type arrangement. Make sure you're paying for it. It's got to look like this entity just rented the place to you and you came in off the streets, right? What would that relationship look like from a short-term rental perspective? So let's look at just a high-level example of what a structure like this might kind of entail. So John, here's our guy up here, the individual that currently owns everything just in his name personally. And so what John wants to do is he wants to set up this family partnership structure, right? A family partnership LLC, make it a Delaware entity, right? I mean, you can set it up anywhere for the most part, but Delaware is obviously a good jurisdiction. The laws are favorable there, so we'd like Delaware. And so John is going to own the majority of this entity to start with, because again, I mean, these are all his assets, right? He's putting the assets in there, and eventually he's going to add his kids or add, like in this case, we have 2 kids. He's going to add his small partners, just 1% shares. He might add an irrevocable spendthrift trust in there. That's good for liability protection, creditor protection, and then maybe he even goes offshore. Right, so he wants to set up a Cook Islands trust for some even more robust type of asset protection strategy, and this is all permissible, right? A family partnership, a U.S. partnership can have as many number of partners as it wants, and it can admit whoever it wants as a partner too. There's really no limitations there, and so this is in contrast. For those of you watching that are familiar with, let's say, the S corporation. S corporation structures are not ideal in this context because you can only have basically natural persons as shareholders, and you're limited to 100. And it's the natural persons thing that is usually the biggest predicament, because when you use certain trusts like these, or you want to add, let's say, a corporate entity, let's say you just have a corporation that you want to make a partner, none of that would be permitted in an S-corp structure. So you've got to have this this partnership structure where you're filing a 1065 every year and you're not doing an 1120S. Okay, so that's very important to remember. And so what's the point of this management entity out here? This is the GP entity that's going to, quote, run the operations of the LLC. So John doesn't want to hold that GP interest in his name personally because there's more liability exposure there. So what John does is he sets up a separate management company. It's taxed as a C Corp or an S Corp. That owns 1% of the family partnership, which is the GP interest, right? So that 1% isn't going to change at all over the course of the entity's life. And then John owns 100% of that. So this initial structure here, these three boxes, this is what creates the partnership down here, which is what we want. And then as time goes on, John might decide to add the kids as partners through gifting, interest, set up some trusts, maybe one for each kid, perhaps even one for himself, and he just relinquishes control to a trustee. That might be okay in certain circumstances. He could set up charitable remainder trusts. There's a whole bag of different options that you've got when you go down this type of planning structure. And then so down here, what do the investments look like, right? So the LLC is going to set up its own brokerage accounts, right, to hold the stocks, to hold the bonds. Crypto, right? I mean, let's say it opens a Coinbase or a Binance account or Bittrex, something like that. Or even in cases where, let's say you want to hold it in cold storage, right? So you've got crypto on one of those electric cold storage keys, right? It's basically a USB drive or even just paper wallets. Those can all be permissible. Then you put them in a safe deposit box under the LLC name. That's okay as well. That's very common nowadays because a lot of these exchanges are getting hacked, and so having crypto held in cold storage is certainly better from an asset protection standpoint. And it makes it hard for creditors to track it, right? I mean, if you've got crypto held in cold storage and it's in some safe deposit box down in the Cayman Islands, yeah, it'd be tough to find out that that's there, right? Fine art and collectibles, this one's kind of rare, but it does happen because nobody really wants to part with it from their personal home, but you can transfer fine art and other types of expensive valuables into a family limited partnership like this or into a trust. The only issue though is once you do that, you can't really display it in your personal home because you didn't really get rid of it, right? It's got to be in storage somewhere. Or in certain cases, you can transfer it and then still display it in your home, but you're renting it. That's another one that I've seen before, not too often, but in effect, what would happen is you do just that. You transfer it to the partnership, and then you would still display it in your personal home, but then you would have to pay rent, kind of like an art gallery type of issue. You would pay rent into this LLC, which would ultimately be recorded as income. And so a lot of people don't like to do that because they think it's kind of phantom income, and I guess it is. I mean, you're paying something into a fund and then immediately having to recognize it as income when it comes out the other side. Maybe not ideal. And then the same issue with the vacation property, right? I mean, if you have a property that's in this type of structure and you're going to use it for personal use, you're going to have to pay rent, right? Because if you don't pay rent, then it could dismantle the whole thing, right? You've got personal use of business assets, doesn't look good, right? The way to defeat the personal use argument is if you are using it as any kind of other third party would. You go through the same terms and conditions, you pay rent just like everybody else under this below market rate nonsense. If you do that, then you should be okay. Okay, so I think that addresses everything on this. I mean, the takeaway again is, look, the LLC type of structure or maybe a trust is a very good asset protection tool, right? You can use them to safeguard your assets and your business interests, but you need to be very careful to do it in a proper manner because just simply setting up an entity and dumping stuff into it is not going to accomplish what you want. In the short term, you might think it's working because you just haven't been sued yet. But the issue is when push comes to shove, and if you are sued or you're facing some other type of lawsuit or dispute with maybe an ex-parental, former business partner, if this isn't properly set up, then they can easily just take it apart. So yeah, moving stuff into an LLC can work very, very well. but it has to be done appropriately. So, okay, thank you very much for watching. I appreciate it. If you can give me a like and a subscribe, again, very much appreciate all the viewers. And if you have any questions, please feel free to comment on the video below. I love responding to the comments, and a lot of the other questions you guys have are very. It gets the brain thinking, because you never see every issue. So, all right, thanks so much, and I look forward to seeing you again.